This Environmental Markets Roundtable on ESG assembles members of the World Federation of Exchanges to explore and maybe answer the question, is ESG dead? I'm Sally Duros, reporting for John Lothian News. This question has been floating by for some time in headlines in the Financial Times, the New York Times, the Wall Street Journal, and other major publications. It's easy to say the question indicates wishful thinking on the part of businesses who would just like the term and the regulation it threatens to disappear. But that's not the case. The headlines arise from evidence, perhaps the most visible being a retreat by Larry Fink, CEO of BlackRock, the world's largest asset manager who has been a champion. The Wall Street Journal reports that Fink has purged the letters from his vocabulary. Another highly visible trend is political pushback in the United States. While 4 states, Colorado, Illinois, Maine, and Maryland, have passed laws encouraging public pension funds to include ESG factors in their investment decisions, 14 states have done the opposite, adopting laws discouraging ESG or banning ESG altogether. That is what we'll be exploring today, and leading our conversation is Nandini Sukumar, Chief Executive Officer of the World Federation of Exchanges. Welcome, Nandini.
Hi, Sally. What a pleasure to be here today at this virtual roundtable talking about a burning question for all of us. Is ESG dead? Here with me at the WFE are a group of leading thinkers and activists, if you like, in the ESG space from the exchanges, our members. I'd like to introduce you to Tomas Thyblad from Nasdaq, Laetitia Hamon from the Luxembourg Stock Exchange, Gordon Bennett from ICE, and WFE's very own Victoria Powell. As you know, the WFE, established in 1961, is the global industry group for exchanges and clearinghouses. We're headquartered in London. Our members from all around the world, as this distinguished panel demonstrates, and we support and develop and enforce high standards of conduct. We seek outcomes as a group at the Federation that maximize the common good, consumer confidence, and economic growth. And a key part of that mandate really is thinking and talking about the role of exchanges in ESG, because that's something all exchanges are preoccupied with and engaged with. We have a sustainability working group. Every one of the members on this roundtable are organizationally members of the working group. The Sustainability Working Group of the WFE was set up in 2013, so a long time ago, and has done a lot of interesting work with members, including defining green equity. Now, why are we here today? We're all here to talk about the topic, is ESG dead? From the exchange side, the exchanges, let me give you some facts. We have a survey that we run every year. It's open to exchanges around the world. You can be, whether they're member or non-member, and it's entering its 10th year. So it is a snapshot of trends, themes, and thinking in the industry. In the last survey, for the first time ever, every exchange responding participated in at least one ESG initiative and engaged in at least one of the WFE sustainability principles. This is a milestone in the industry's collective efforts to achieve sustainability. Many of the respondents reported engagement with at least 12 ESG initiatives, which is twice the number observed the year before. And not only has the number of exchanges engaging in ESG initiatives increased, but the average number of initiatives implemented per exchange has also increased. A key piece of work that we did at the WFE with the members last year was working to create a global framework that individual exchanges can use to establish a green offering for listed equities. And we have in the roundtable 2 of the pioneering exchanges that have worked on green equities right here. So they'll be able to tell you more. Sustainability concerns and opportunities for business expansion are normally and consistently the most frequently reported motivation for ESG engagement. But we've seen a tipping point in the last couple of years where opportunity has outstripped concern.
I see a number of issues have emerged about the viability of ESG as an investment framework. And in the United States in particular, we're seeing a lot of this. It's quite vigorous. It looks to me that the major concerns are greenwashing. Some see commitment to groups like Net Zero Banking Alliance, the Boardroom Accountability Project, the Equator Principles as window dressing. So are companies in general truly committed, or are they just joining these organizations for show? Another issue that has been bubbling up in the headlines is that of the emission producers. They are not committing to reduce emissions. This is a problem. I know that there's a long timeline on net zero, but they have to start at some point. There's a lot of unhappiness about that out there. A third issue that I've seen a little bit about is the ratings agencies and how they kind of set the grade for a company's performance in terms of ESG. And there appears to be a black box where the actual rating itself is determined. So people are asking, how can we count on these ratings? And then, of course, there's the role of regulation. Are people just acting because they think regulation is either in place in Europe or they see it coming in the US? And of course, our recent SEC actions were weaker than some people wanted. I'd just like to, get some thoughts from all of you, from each of you, on those issues, or how you, from an exchange perspective, are addressing those concerns.
To a certain extent, I can imagine it's a sort of reaction with the ESG label per se. I think the ESG label, it's sort of a simplification of an extremely complex area. I mean, the sustainability is very complex. There's so many different factors, etc. So it is a balancing act between a label, whether you use the acronym ESG or something else, a balancing act to have like a traffic light system for which is a good investment or not. And I think versus how complex the issue is and how many different factors and nuances it is. So I think it's maybe a healthy perspective to see, to ensure you have all the facts on the table, all the different data on the table, and thereby enabling the investors to make informed decisions and investment decision that fits their profile, so to say. So I think we can see for the last years that it has developed a lot. It's much more data out there. It's many different solutions that have come up to help both corporates and investors. And I think that is a giant step. Of course, we would like to see this to go faster, but I think we are still on the right track, and we do start to take these factors into account more and more.
There is more and more data around ESG and enabling investors to make informed decisions. Although, and you mentioned it, Sally, just earlier in your questions and the questions related to rating agencies, there used to be in the past a use of rating and scores in a kind of a blind way. So we're taking those for granted. But now I think there's an evolution still around the data side, that investors want to know really the source of the data. They want to understand how they've been aggregated, how they've been computed. And I can say that because 15 years ago I was working for an ESG rating agency. And you can see the blind spots of these kind of things. So it's also important now for the ones using the data to really understand what is it that they are using. Especially when we talk about, and it's probably going to happen in discussion, talk about transition finance, you need to understand what is a scenario, what are the data, if they are science-based, if they've been verified. All this kind of information is super important, and especially if we talk about greenwashing, which was your first point there. greenwashing it's true that there is greenwashing. Of course, there is greenwashing in the industry, but sometimes it's also misunderstanding of the data. It can also sometimes be unintentional. It was discussed, by the way, at the level of ESMA or the ESAs, the European Supervisory Authorities. They made a call for evidence on greenwashing, asking what could it be and if we can define greenwashing. And there were two dimensions there. They were trying to ask whether it's only intentional greenwashing or unintentional greenwashing. I don't think the answer has been decided yet, but it's super important also to understand that it's misuse sometimes of the data, misunderstanding of the data that leads to greenwashing as well.
When I think about the question, is ESG dead? I find myself asking when was it born? And I actually remember sitting on I was invited to sit on a sustainability panel in London. I think it was at IDX a few years ago, and I sort of said, okay, I need to go and research when did sustainability become a thing. And when we were sort of planning for this call, someone kindly shared that ESG seemed to be born in 2005 and came out of the UN PRI. But when I was doing my research for that panel a couple of years ago, I stumbled upon the Brundtland Commission, which goes back to 1987, and I read it, and it. I think that was the birth of People, Planet, Profits, or if you don't like talking about profits, then prosperity, because apparently profits is a dirty word, but clearly we need profits and growth to reinvest and grow our societies. I felt that was a far better frame of what sustainability is, and that spoke to me more. And it, to the points made earlier, it is subjective as to what that means for you. And I think that trying to put three-letter acronyms to complex problems like sustainability is like this search for simplification and objectivity. But if the underlying is subjective, that is a sort of a fool's errand. So it's an oversimplification, especially on the rating side, to say, okay, if you think about the diversity of what's in ESG, to go, okay, this company's an 8 and that's a 6. And I sort of agree with the sort of the black box comment. It's quite difficult to understand how different ratings are weighted. So I, from my perspective, it almost becomes a bit meaningless. But I think that's just an innovation cycle, and that's just the market discovery process, and so it needs to evolve. I think lastly, the thing that's a little bit disappointing for me, if we had the Brundtland Commission in 87 and ESG in 2005, why isn't it more mainstream? It feels like it should be more mainstream than it is today, and instead of I think sustainable finance, thematic finance, ESG, green economies it'll be successful when we stop labeling them as such, and it'll just be finance and it'll just be the economy. And the challenge is we have to effectively reinvent our economic model, and there's a lot of inertia behind the existing one.
I think you're right, Gordon. It's when you integrate this into the whole economy. It's when you integrate these issues as not a separate framework. It's in every single business decision, whether it's a business decision in a corporate or an investment decision at an investor level. That's when it becomes effective. So it's like a risk framework, for instance. If you don't implement it into an organization, if it floats around as a separate satellite, it doesn't become effective. It needs to go into the organization or the investment decision. I think that, like you said, it's a maturity process, this. But at least the good thing now is that we have more and more data to use. I think it's more and more common to take all these factors into account, probably in different ways for different investors, and that makes sense because it is a different profile. But I think that is on the positive side, at least.
I was doing some research at John Lothian News, we have something called Markets Wiki, and I have an ESG page there that I've been trying to work on, and I have to tell you it's vast, and I have not been making all that much progress. But in doing some research, I came across the Brundtland report, and I also came across a quote by by Paul Clements Hunt, who supposedly created the ESG moniker. And he said exactly what you said. Stripping away the white noise in politics, ESG is simply a way to manage new and evolving risks as a result of policy changes and mitigate them where you can. So it's risk management at its bottom line, right?
And going back again to that famous Bretland report, and I must say that Miss Bretland was a woman Prime Minister of Norway, a very important point if I can mention, back in 1987. But at the time, we were defining only sustainable development, not sustainable finance. So obviously, those three pillars, and it was actually social economy, economic growth, and environmental preservation back in this report was sustainable development. Then before, in 2008, around that, we had different strategies that we could hear about, like best-in-class engagement, integration, and all those beautiful terms that we had at the time. But sustainable development and finance only came together at the Paris Agreement in 2015. But we, in 2015, started to understand that we needed finance to finance a sustainable development, and that money was needed for that. But still, until then, we make the distinction between finance and sustainable finance, which to me is an issue, because in any way, finance should be sustainable. But as long as we continue to use the term sustainable finance, it means that there is something that is good, sustainable finance, and then there is finance that can continue its own way. So as exactly what Thomas said, it should be integrated more and more. And it's not anymore only an ESG risk way of thinking. It started with that maybe at some point, and especially with the task force on climate-related financial disclosures that were really risk-oriented. But looking at, and especially in Europe, that action plan on sustainable finance that came out in 2018, there were exactly two dimensions: ESG factors and ESG risks. And these two aspects are absolutely crucial if you want to look at what is the impact that you're having on the planet, environmental and social impact, and what are external environmental and social risks that can impact the assets that you're investing in. So it's a two-way dimension, and it's called double materiality. So it's not only a question of risks, I think, at this point, it's managing the two.
Laetitia, you just framed that so well, because I think what we've seen very much is during that entire period, more people entering the debate and engaging their thinking on it. And as a result, you've had a lot of evolution and I think ESG and sustainability as a whole is very much on this whole journey in terms towards climate mitigation is very much a journey and not a destination alone that we're just going to arrive. No, we're just constantly trying to improve everyone along as we go along towards meeting the goals that we need to achieve through the Paris Agreement that you identified. So I think that's quite an important point. And as a result, more people have got more interested in it and asking more questions. So the detail of the ratings methodologies have evolved as well. And also their ability to come up with a methodology and a rating, because there is more data, more accurate data coming. So we keep evolving and improving what's out there, which I think is really critical.
I was going to agree with the comment that it is about risk management. And Thomas was talking earlier about data, and exchanges have evolved into big data businesses over time, and therefore when you're thinking about sustainability and so forth, then you need access to a whole host of different data, and ICE has been building that data set over time, and Jeff, our founder, Jeff Sprecher, was one of the first movers into the data game to complement the sort of the origins of exchanges, which is price, which is important in terms of risk manage. So how do you risk manage without price? And I think you said you're in Chicago, Sally. So I was lucky enough to interview Professor Michael Greenstone from the University of Chicago last year. I asked him about price and how important it is, and he came up with the line that without price, you're in the land of the fairies and unicorns and pots of gold at the end of the rainbow. And it's exactly right in terms of how do you make decisions without knowing the price of things. Price gives you choice. So, and that was the original premise of exchanges. So exchanges effectively democratize price transparency, and that's extremely powerful. Exchanges are regulated, so you're operating in the sort of the highest quality and integrity, and so this is integral to letting the market go to work, letting the market feedback go to work. And if you feel that something, it's the ultimate expression of your view of value if you have to back it up by buying or selling it. And so if you think something is good value, you can buy it. If you think it isn't, you can sell it. So that's the beauty of markets for me, and futures markets in particular, or regulated quoted markets. I'm an accountant by training, and quoted markets sit at the top of the fair value hierarchy, because of the most precise form of value, and people are buying and selling all day long. Now, I'll pick up on the point around double materiality, if I may, and it's on the outer borders of my comfort zone, but the way that I interpret double materiality, and feel welcome to correct me, is that you've got one bucket which is basically financial materiality, and then this other bucket which is something else that you can't put a number on it. The thing with sustainability, and particularly around the E, I'm the global head of environmental markets at ICE, you can actually put a number on the E from a climate point of view. Again, another Michael Greenstone quote is, the atmosphere is free. It doesn't take an advanced degree in economics to figure out the things that people get for free they use an awful lot of. But we can put a price on pollution. We operate carbon markets. We can price the negative externalities. And we can also price positive externalities. So externalities is part of economic theory. We operate markets that helps us put a price on them. And a bit like sustainability, it's not become mainstream yet. 75% of the world's emissions are not directly priced, and the ones that are effectively mandated by governments. So you have to be made to pay for polluting. And so the challenge is, how do you get the other 75% to use these tools that allows you to stick something that's in the other bucket into financial materiality bucket? And so that, again, that's a little bit more disappointing for me in terms of the mainstreaming of sustainable finance and the using, the usage of tools that are available today, and we have a pretty good idea that they work.
I think the role of the exchange here, that what we can do to help to as Gordon said, to democratize the data and to support the transparency in the market, because then I think the data for the corporates, both inbound and outbound, so to say, is going to be so important, and also the access for the investors. And then that is very much the role of the exchange to ensure the transparency, and thereby let the price hopefully be reflected by all these different factors. I fully agree that the environmental factors are easier to price, like the carbon. Probably other parts, biodiversity, etc., is pretty difficult still. But at least it's there we have a start to build in the price of the emissions, even though we have, as you said, Gordon, we have a long way to go to capture the whole economy.
I understand from looking at some of your materials that governance has been a place where you think that there's been a lot of progress. Do you agree with that?
I can speak from an asset perspective. We provide quite a lot of different tools, etc., and support for the corporates. I think that is G is a given. You need to have good governance for all your operation, not only for the if we use these acronyms once again, the S and the E, but you need good governance in order to operate and steer your company in a prudent and good way. That is, of course, very important. And there we have a range of different solutions to simplify that work, to improve that work for the corporates. And that's what we want to do, support the listed corporates.
You made the point about how governments had made, for the Paris Agreement, they had said that they would reach certain targets. So they've made commitments, and that means that there is a funding gap. And initially, I think people were thinking about how do we encourage funding and markets to be used to address purely green industries. But I think one of the things that we're also seeing is the need to address the whole transition. And I think that's where we're also seeing an evolution and a nuance in the frameworks that we need to be able to do that. And we've got a good example that governance, in a sense, that framework already was so firmly already established that it's been much easier. And the reason I think for having any label whatsoever has only been to draw attention to the need to integrate what you would expect to already be integrated. But and I was just going to ask Laetitia, maybe she has more comments on that element as well, the transition side.
I agree, of course, that pricing is an incredibly important element when we want to make sure that we value properly sustainability, and we need to have this information. Although it's not the main incentive, or it can be the main incentive, but it's not the only incentive investing in sustainability or sustainable assets, if you wish. And as you mentioned, Victoria, there are a number of investors, especially in Europe, but that's coming everywhere in every region. They have made commitments. Sally mentioned that also with the defense and everything. They've made commitments that they need to show that they deliver on this commitment. That's one thing. So they'll have to show that they invest in those sustainable activities that create an impact as well. So they'll have to look at the risks and look at the impacts as well. And there's a number of regulations also that make them accountable for reporting on the environmental activities. They have banks, for example, in Europe will have to disclose their green asset ratio, so the number of green assets in their balance sheet. Investors will have to disclose the level of EU taxonomy alignment of their investments. So they have to look at these kind of things as well. It's not just for the beauty of doing it. They have, in terms of regulatory purposes, they have to look at the impact as well. So for example, on the LuxSe side, and talking about data, as Thomas mentioned, that data, especially since we're specialized on sustainable bonds, that data about the impact of the projects that have been financed by sustainable bonds is absolutely crucial because investors use this data. And we've been, for example, creating the LGX Data Hub that gathers 14,000 secure sustainable bonds in there with information about exactly what is a sustainable bond financing, what kind of projects, and what is the environmental and social impact that has been generated alongside with reference data and pricing and everything. So that's a thing that is important. Now, talking about transition, of course, and there's a need to finance not only those assets that are green, but the ones that need to shift from brown to green. There is a myriad of guidances that have been published over the last year on that topic and how to make credible transition plans and all of that, what makes transition credible. So there's a lot of discussion then. I think the market needs clarity, but there is, at least on the fixed income side, a number of instruments that can help. For example, the sustainability-linked bonds that where issuers fix key performance indicators and sustainable performance targets at the level of the issuer so that they can say, we want to reduce, for example, our carbon emissions by 50% by 2020, and they have to deliver on this. It has to be verified as well. By the way, the KPIs has to be verified, and if they are not met, the issuer, there's a trigger event that happens, and usually the issuer will have to pay more to its investors if it cannot meet the targets.
One of the challenges with, if we're thinking again from where I sit, clearly very focused on the E and net zero, but I think that it's hard to argue that climate risk isn't the sort of the existential threat, and so perhaps E is the most important, but ultimately that's subjective. If you agree with the comment that the root cause of climate risk is that the modern, or not the modern economy, the incumbent economic model since the dawn of civilization made the assumption that the atmosphere is infinite. We've known for quite some time it's not. So actually the atmosphere is the ultimate scarce resource. Then you can use economics to solve for that. And so for me, it is very much about price. And whilst target setting is important, are you more likely to seek abatement opportunities if they're at a lower cost than polluting versus not paying for your pollution? So again, if the root cause is not paying to use the atmosphere, you need to fix it by paying. And by paying, you're incentivized to seek lower cost abatement opportunities to meet your targets. Just setting a target and saying, I'll get there. I mean, the challenge is that we're talking about something that's well into the distance, 2050 and so forth. No one knows what net zero looks like. No one knows what the energy mix is going to look like. If they say it, then no one can forecast the future. I don't care what your superpower is. It's not being able to forecast the future. And so you need price. It's a complex problem. It's effectively how the world works. And there's no expert. I mean, I feel a little bit uncomfortable talking about sustainability and things as big as net zero, because in terms of how much sitting in your seat is so small compared to how the world works. But again, that's why I'm a firm believer in markets, because markets help you solve for complex problems. There isn't a person. There are maybe organizations that you can put together that can get the picture. But then the uncertainty of the future, you can never be sure. I think one of the challenges around ESG and net zero, it becomes a bit too dogmatic, and again, oversimplification. It's either right or wrong, green or brown. And one of the best comments I had recently when I was in Abu Dhabi, someone described net zero or energy transition to be khaki. And I think that's a great way to think about it, because you just don't go from brown to green. And in fact, so the green economy of the future is underwritten by the brown economy of today. The joules that we're using today that are building wind turbines and solar farms and electrolyzers are done through the combustion of hydrocarbons. And so if it gets too binary, we're not going to solve for anything. It's a bit like where, again, going to net zero and energy transition, there's this stakeholder group that will say, oh, it's a supply side problem. You're serving me hydrocarbons, you're bad people. But it's like, if you think about, not picking on aviation, but it's something that is familiar to lots of people. The only reason energy companies produce aviation fuel is because we like to fly. So it's clearly not a supply problem. It's supply and demand. And the demand side is really important, because we've made all of these amazing sort of efficiency gains in terms of how we deliver joules, how we deliver energy. But the old Jevons paradox is we basically lose all of the efficiency gains because we consume more. So we really need to think hard around the demand side to deliver a net zero pathway. But I think price is really important. It's not everything. You need great policy. As I said earlier, most carbon pricing today, that polluters that pay, is made by government, so that's policy. But I'm a firm believer in the beauty of markets.
Gordon, one of the points you just made, though, is so critical, isn't it? Also, as you say, in a sense, companies need to be incentivized to be able to invest for the longer term when they're under pressure for dividends that year. So that needs to be baked into price more effectively, which is why I think, considering something like the fact that it's the long-term goal of 2050, that kind of investment and that directing of whether we want to call them brown or khaki energy elements have to be sort of driven to be thinking about that long-term adding of value. And I think what's also interesting is that we won't, because it's such a long-term project, we won't actually achieve it unless we also take into account the S and the social side of it. Because if not, it's a long journey and we're going to create a lot of people who are quite angry and fearful about what's possible for them. And so we do need to think about how we transition jobs, how we transition the economy as a whole, how issuers themselves are going to manage that transition in a way so that is smoother for the whole of society, and that has an impact because it's supply and demand on both sides of the market. And I think that's a really important element of why the social side does matter if we are going to be successful in this endeavor.
The social side is something that I've given some thought to. I think about data a lot. How do you get to the data? It seems to me that some of the rumblings we've heard from farmers and others in Europe have to do with collecting data, perhaps. Does social change happen along with this environmental movement?
I mean, quickly, it's a little bit outside because I'm more on the markets business than the data side, but And I agree 100% that clearly the social piece is important, but also having a livable planet has a big impact on the S as well. I mean, I suppose the challenge with the data is there's so much data now. We're just constantly generating more and more data, and there's a real skill of being able to collect data, clean it, and then be able to redistribute it so it's usable for investors and governments and other stakeholders. But ICE is investing in the social side on the data for sure, and trying to, particularly in the fixed income side of the business, we built a lot of data on the building S data and sort of overlaying that in terms of municipalities and municipal bonds. And so rather than just looking at it from a sort of a historical economic view, then you can overlay some of the S factors in there as well. And the same goes for the physical climate element. This is both in the sort of the fixed income space as well. We've made quite a few acquisitions in this space, bringing in physical climate risk to assess sort of municipal bonds and so forth. So that municipal bonds is very much around people. So that's been a big investment area for us. But I suppose the challenge is, whilst again from where I sit, we do have these tools that you can use to value E. I'm not sure if there's like a tool like a carbon allowance or a carbon credit or an energy attribute certificate that helps you sort of figure out what S is, brings some objectivity to S rather than it being very sort of qualitative rather than quantitative.
The social data is a key question, key element. It's a very complex topic as well. For example, in Europe, the EU taxonomy has started to focus first on environment, most probably because environmental data can be backed by science in some ways, or you can hopefully find international consensus about how to calculate this data and account for them. Whereas on the social side, it's way more complicated. It's slightly more subjective sometimes as well, and it's more difficult to then get this data. And if we talk about, and that's why, by the way, the EU stopped the social taxonomy idea, because it's a complicated topic. But also when talking about social bonds, for instance, because we've got this experience as well with the LGX Data Hub, a bond financing social projects, when it's clearly identified, like in the municipalities, affordable housing or things like that, is kind of easy to do, but most of the time the social dimension is very transversal and can appear in many different areas, categories that are being financed. I can give you a very concrete example. When we look at gender bonds, for example, this is something that gender-focused bonds, as we call them, under the LGX platform. When we started to look at them, we're thinking that maybe there would be bonds that finance 100% gender projects, but no, it's a gender lens, or it's a social lens that you apply to different types of investments. So we found, for example, green bonds financing, and I've got one example in my head, a green bond financing a metro infrastructure in a city. But then they looked at the gender component to see whether women can access easily this infrastructure at night to be safe and secure. And so there is a social dimension that is integrated, but it's not the purpose of the investment. The purpose of the investment is to finance a green infrastructure. So that social lens is complicated to identify. It's complicated to report on. It's complicated to measure the impact. And that's probably why we're a bit lagging behind on the social side. But as Victoria mentioned, when we talk about transition, we need to talk also about just transition. And just transition is the fact that you transition, leaving no one behind, or trying to leave no one behind, or trying to transform the jobs that will be made redundant in the future as well. So I'm not saying that it's easy. It's super complicated to address this topic, super complicated to define it, super complicated to have an international agreement on that. But these are the kind of discussions that we need to have also right now, because if we don't do it right now, then they will appear even worse in the future.
I'm just really curious, actually, with my colleagues. One of the things that I think is, as you say, we've got some products that can help support, but also from the data perspective, one of the things that I think will assist in understanding the implications and applying a lens on the impact is transition plans. Because if issuers do have clear transition plans, it gives them the opportunity to think about where they are, the entire project, the entire product chain and so on, and supply chain involved, and reporting on that. And also that way you begin to think about, okay, where am I having unintended consequences? And then you can start to assess that more effectively. And I think in terms of credibility as well, there's the other element that we're beginning to address now, which is how can you assess that those plans? It is fine for them to evolve, but are they credible, and were they genuinely thought through, and how are people really sticking to them? And where they're not sticking to them, there might be very good reasons for that. Something else cost more to do and there was a shift, but that dialogue needs to be transparent and tested by investors. Thomas, I don't know if you've got any thoughts or...
No, I think as we have said now, the transition plans and the companies on the transition path, that's the key. I mean, that is the bulk of the companies and the economy. So that is so important for us to bring along and get them on the right track. I think it's almost like a pendulum that for the last years has been such a focus on what's green and what's ESG, and like really already done deals, so to say. But it's very much now focused on credible paths to net zero, for instance, credible, that you need to show credible transition plans. And I think that's quite healthy. I mean, Gordon, we are focused on the carbon side, and you from the allowances, primarily on the allowances side. I'm very much on the carbon removal side. So we know that earlier was more like a quick fix how to get to net zero, climate neutral now, more or less. I think the shift is more on a credible path, and how you embark on that journey, how you do it in stepwise, have good targets, etc., and how do you actually manage the residual emissions. And I think that is positive, and that is a credible way to handle it. And just to one more comment to come back what you said before as well, Gordon, on the market side. I think for the carbon, for instance, it's of course it would be ideal to have this global carbon tax, and would fix the problem right away. But I think that is probably that unfortunately sits in among the what do you say, the fairies and the unicorns.
The fairies, yeah.
So, but I think we need to live with the system where we have the compliance markets. You have different regimes in different regions, and then parallel with that, we're going to have the voluntary carbon market with the companies that can set their targets and go above and beyond that as well, and utilize that tool in the economy. And therefore, it won't be a perfect pricing in the market. There's going to be many different prices. But at least we get some price on this, and we can leverage on these market mechanisms.
Yeah, there should be many different prices, though. We don't need a global carbon. I mean, if you think about a global carbon price, okay, it's the price of basically the marginal technology that delivers a net zero pathway. So that is the price. But in the same way that you can. Countries' energy systems are all different. Countries' pathways around their energy systems are all different. Producing carbon savings, reductions and removals, just like there's different ways to produce electricity, whether it's nuclear, gas, coal, wind, solar, they all have different production costs. So they have different prices. They can be sold at different prices, and so carbon reduction and removal technologies have different production costs, and so they can be different prices. I think it highlights one of the challenges of sustainability and climate, in that it's difficult to have proximity to each individual country and person's issue, right? And so historically, or I used to talk about energy transition, but actually it's no such thing as an energy transition. There's hundreds of energy transitions, because in Africa there's still hundreds of millions of people that don't have access to electricity. Their decarbonization pathway is clean cooking rather than cooking on open stoves. and suffering the health issues with that. And here's one definitely sitting in the sort of the bullseye of S in terms of clean cooking. It's a little bit of a travesty of society that we're still talking about people not having access to clean cooking in Africa. It's something like 1 billion or 1.5 billion tons of CO2 we could reduce by making an $8 billion investment. But the other thing around it is that it's basically females and girls in particular who go getting the biomass to do to then do the cooking. And so it's sort of, what's more powerful than educating girls and saving the planet? And you can solve that for $8 billion, but sitting in 2024, we're not putting the finance to work. The money's not flowing from developed to developing. That problem really shouldn't exist today. And I think part of that is because we don't have proximity to it. We don't see it. We don't feel it. So that again, that's a bit disappointing in terms of our sustainability journey. We should really have solved for clean cooking by now if the Brundtland Commission was out in 1987.
I think this is a fascinating conversation, and all the issues related to social and transition financing as well. I mean, I think we're going to be doing another roundtable in the future on transition financing, and also carbon is a good one too, I think, to get into the details on. So, I mean, I guess the final question is, where do you see ESG going? If each of you wanted to say like a few words about that, and then Nandini can wrap things up.
Sure. I think, as I said earlier, it will continue to evolve and innovate. I think it's increasingly mainstreaming. There's no turning back now, and so I'm optimistic we'll get to a world where it will just be finance. My worry is that, so we're collecting data and we're disclosing better, but it's just the sheer volume of it. I mean, whether it's TCFD, TNFD, and all this other stuff, it's so, again, I'm an accountant and I can't read a set of accounts anymore, and we're just creating more and more information to consume. So it's really hard to think about how do you make decisions around certainly investing in companies when you have to plow through all of this data to sort of help you come to an answer. So I think that's really one of the challenging pieces, is just the sheer volume of data and information you need to make decisions these days. But I'm optimistic that we're on the right pathway. There'll be some bumps in the road. Failure is the part of market feedback loop. It's things are supposed to fail, so we shouldn't get. Another great quote I came across was trial and triumph. So we need to continually trial and triumph with respect to sustainability.
Thanks for that, Gordon.
I can just echo that. I think we are on the right path. It's going to continue to evolve. I think one key component, and I see tendencies with the tools for that is to assess the materiality. And that is both ways for companies, for investors, both in double materiality as well. To simplify that and have tools to help the corporates and the investors to do that assessment. I think that's going to be key. Otherwise, whatever we call it, ESG or sustainability or whatever label, that is irrelevant. We just need the factors, these very important issues to be implemented in the decision-making process.
Okay, so my turn to end up the discussion then, I guess. Maybe a last word on the role of stock exchanges on all of us here around the table. I think our role has evolved way beyond just, the activities that we had in the past around listing trading, for example. But we now are way more involved into education, into data, into capacity building, into trying to scale up finance and shift the flows of finance towards sustainable assets or transitioning assets. So there's a lot that we can do in those capital markets really to foster sustainable finance. And as to the term ESG, I've been in this industry for the last 15 years. I've seen many changes into the terms, many acronyms that came into the picture. But maybe there's one key message around that, whatever we want to call that ESG thing, we should really try to avoid confusing people even more. There are so many terms already there. We should not overthink it. We should not, and I don't know if it's an English word, over snob it. And try to pretend that us in our own bubble of ESG, we know everything, and we use clever terms. We should make it simple, keep it simple, not to discourage people for joining us in this, and trying to thinner that barrier between sustainable finance and finance, I'd say.
I would echo that, and I think that we just need to be willing to accept that sometimes we learn as we go, and we keep improving and becoming more nuanced, thinking about different aspects that we need to take into consideration, and that involves all the different parts of the market, which is why, for example, data and transition plans, etc., are a new element, and focusing on transitioning the broader economy has become more of the discussion as we've progressed, which is a great thing, but it's not a black and white issue. So we need to keep working and improving.
Thanks, Victoria. If I had to sum up what we've heard and spoken about for the last hour or so, I would say two things. One, ESG is clearly not dead, but what we are engaging with now, or the road that we are walking down now, is really just it's a realistic understanding of what it will take for us as a society, as a financial ecosystem, as kind of a collective group of people globally to make that transition. So the conversations that we're having now are more detailed, they're more specific. As we begin to walk the road, we understand where we need to stop and do some work before we can keep going. And that's really what you're seeing now, and that's what's really been evident to all of us in this conversation. The second, for me, clear takeaway was that different parts of the world, different parts of society will move at different paces for very obvious reasons. Gordon gave us a great example of what decarbonization might look like. So as we have begun to progress down the road, we are now in the not the weeds, but we are in the details, and details will lead to further questions. So really what we are doing now is we are grappling with the details, and it's no one expects that it will be a short journey, but it's very clear that the direction of travel is in one direction, and that in a year's time, if we were to have this conversation, we'll be talking about quite different things on the road.
Thank you for that, Nandini. Thank you, everyone. And thanks for joining us on this conversation.